The Bank of Canada saw an increase in its inflation rates by 0.2%, pushing it up to 2.9% yesterday. Now, the big question behind this is how is that going to affect the Bank of Canada's ability to cut rates moving forward and going into the future? My name is Miles Noack of the Noack Mortgage Team, powered by ND Mortgage, and today we're going to take a quick look at this increase in inflation and what it means going forward. And if you stick around to the end of the video, we're going to even touch on why we think that Tiff Macklin and the Bank of Canada may be shifting their mentality behind monetary policy and future rate cuts. So let's dive in. As mentioned, the Bank of Canada saw an increase to its inflation rate of 0.2%, pushing them to 2.9%, which is not necessarily what they wanted to see considering they've been trying to battle inflation, getting it down to that 2% target for a couple of years now. And that is kind of the reason we've been seeing such aggressive rate increases out of the Bank of Canada to the overnight rates. Now, as we look at this, we want to understand why the inflation is increasing. And from the data we're seeing, it shows a month-over-month increase of 0.33%, which isn't dramatic. But when we look at the core inflation, being the median and the trim, increasing from 2.7 to 2.9 and from 2.8 to 2.9, according to the Daily Digest on the Bank of Canada's website, this is definitely not something that they wanted to see. Now, this isn't necessarily the be-all and end-all. 1 month of bad data does not create anything definitive. What the Bank of Canada is going to be looking for is trends. And that's what's going to help them dictate on whether they're going to increase rates, decrease them, or potentially just leave them stable. Now, we all know that the Bank of Canada has a meeting coming up in about a month here. And the big question was, are they going to cut rates? Now, me personally, I didn't think they were going to cut rates in the first place. I thought that they were going to hold them steady at this next meeting and potentially have 1 to 2 more decreases through the rest of this year. Now, when it comes to rate cuts, as mentioned in a previous video, I firmly believe that cut was just them dipping their toes in the water to see what would happen. And as we've seen, the numbers didn't necessarily go the way they wanted them to. And this sparked some questions at a Q&A when Tiff Macklin was doing a presentation in Winnipeg. Now, of course, he was asked when he expected rates to go down, how far he expected them to go down, and how far they were going to cut to try and help people with mortgages. His response to this, of course, was nothing. He can't generally tell you how many times they're going to cut rates. He can't generally tell you that because we don't have the data to allow him to do that. Now, they're working on gaining that data, but we've had 1 month of bad data. If we see a trend of good data, he'll cut rates. If they see a trend of bad data, they could increase rates or just hold them stable. But that's something to keep in mind with this. The other thing I think a lot of people, and I think a lot of media outlets forget, is the Bank of Canada doesn't actually control the fixed rates. All they can adjust is the overnight and the prime rate of Canada, which is going to affect our variable rate mortgages and our home equity lines of credit. That's it. When it comes to our fixed rate mortgage products, those are all governed by the bond market, which is a completely different kettle of fish. Now, there could be an adverse effect. Let's say the Bank of Canada cuts prime by 1%. That could have an effect on the bond market and therefore have an effect on the fixed rates. But generally speaking, they do not have any direct control over what happens with those fixed rates. And if we do want to see them decrease, which we think they're going to, it's going to take some time for them to do that. That's why we're seeing a lot of customers opting for a 3-year fixed versus a 5-year fixed, or even exploring the idea of a variable rate mortgage as the Bank of Canada just had a rate cut. Now, on the topic of variables, just to put this to bed, I'm not necessarily saying someone should take a variable rate now. I would like to see personally another 1 or 2 rate cuts to the overnight rate before I'm going to advise customers to seriously consider it. Now, when we talk about Tiff Macklin and we talk about him at this Q&A, when asked these questions, as mentioned, he didn't touch on when he thought rates were going to go down. However, the one thing he did bring up is something that's been dubbed the renewal wave, which is going to essentially hit in 2025. And the reason this was brought up and the reason we're looking at this is it did kind of shift how they've been talking about the economy. Now, as we know, Tiff Macklin and the Bank of Canada has been fighting inflation for the last couple of years. And to hear them kind of shy away from that and shift their focus from inflation to the broader economic stability side of things was very interesting. And what really kind of made me look into this and made my ears perk up was the fact that the Bank of Canada just recently released a statistical analysis on the effects of higher rates on mortgages as they come up for renewal in 2025. And the findings of that were a little bit scary, to be fully honest with you. What they looked at was the fact that if people come up for renewal at these higher interest rates, we're going to see probably a 5% drop in disposable income for Canadians. That's going to equal out to roughly a 3.8 decrease in consumption, which is going to affect small businesses and large businesses, people's jobs, and all these other different scenarios. Now, this does really put the Bank of Canada into a bit of a balancing act, walking a tightrope, where on one end they decrease rates and on one end they increase them. Now, the reason we look at this from this light is because if they decrease rates too quickly, they could potentially overstimulate the economy, boosting inflation, putting us in a situation where they have to raise rates even further than they already have later on down the road. Now, if they don't decrease rates at all, if they keep them stable or, heaven forbid, increase them, and they don't let them come down, then we face a broader economic situation being caused by this decrease in cash flow and disposable income from Canadians and the decrease in consumption. It's definitely something we're going to want to pay attention to, but it does show that the Bank of Canada is looking at more than inflation right now. Now, the be-all and end-all of this is inflation came in hotter than expected, hitting 2.9% when I believe they expected it to be around, I think, 2.6. Once again, this is not trending data. This is not the be-all and end-all, but it is something to pay attention to. But more importantly, through all of this, it looks like there's a shift in the mentality behind monetary policy. And the big question, are they going to cut rates? Only time's going to tell. But if I was to give my estimation on it, I'd be willing to bet we're going to see probably 1 to 2 more cuts from the Bank of Canada before the end of the year, and they're probably not going to cut at this next upcoming meeting. Once again, my name's Miles Noack of the Noack Mortgage Team, powered by Indy Mortgage. Thanks for tuning in. We'll chat with you soon.